Okay, y'all, so I'm going to go through the Chapter 4 PowerPoint slide here from the publisher. Hopefully this serves as kind of a review of what we've talked about in class, and maybe it does a little bit of a deeper dive into some of the things. I'm going to do my best to get through this in about 15 to 20 minutes, but please keep in mind that this is a 54-slide PowerPoint. I will post this video to YouTube, so you will be able to increase the playback speed. If you go to the bottom of the YouTube screen, there's a little gear, and within that gear, it says playback speed, and you can increase the playback speed so that it sounds like I'm talking a lot faster. If you would like to do that to try to get through it faster, that is an option that y'all have. So here we go. All right, y'all, so the learning objectives for Chapter 4, we're going to prepare the financial statements. Y'all have already prepared all of the financial statements previously, but we are going to be doing a classified balance sheet, which is a deeper dive into the balance sheet. It gives a more detailed view. We will then be doing looking at the worksheet to prepare financial statements. We will also be preparing closing entries, and we will be doing a post-closing trial balance. Additionally, we're going to look at the accounting cycle, and we're going to utilize the current ratio to evaluate the business performance and explain the purpose of and journalize revising entries. This is an appendix, so we're not going to spend a whole lot of time on those revising entries because they're just not as common. So the first learning objective we're going to talk about are preparing those financial statements, including the classified balance sheet. Again, we have already talked about preparing all of the financial statements, so now we are just looking at primarily that classified balance sheet, which is going to be that deeper dive into it. So the financial statements, the three primary ones that we focus on, the income statement, the statement of owner's equity, and the balance sheet. Keep in mind that the order in which these are listed here is the order in which you have to create them. So that income statement shows us a comparison of the revenues and the expenses. Then we have the statement of owner's equity, and this shows the value that the owner has within the business, and this can change throughout the period. It changes based on the net income or net loss, owner contributions, and owner withdrawals. And then we have the balance sheet, which proves our accounting equation. And just to recap, that accounting equation is assets equals liabilities plus owner's equity. And with this balance sheet, this is the one we're going to do the deeper dive into in this chapter. So how do we prepare those financial statements? So typically we will use an adjusted trial balance to prepare those financial statements. All of the accounts that we need to utilize to create the financial statements are right here in the trial balance, and it starts from the bottom and works its way up in the order in which we create the financial statements. So you'll notice at the bottom of this, you see the income statement accounts. They're highlighted there, and then we see the owner equity accounts, and then the balance sheet accounts are up on the top half of the trial balance. So the next thing we're going to talk a little bit about are the relationships among these financial statements. So there's a reason and a purpose behind why we create them in the order of income statement, statement of owner's equity, and then balance sheet. And so we're going to talk about those relationships here really quick. So the reason why we start with the income statement is because we see that at the end of the income statement, we either get a net income or we get a net loss. This example indicates a net income, and we're going to take that net income number, and that's going to go right on over to our statement of owner's equity. So we see here the statement of owner's equity, and on the statement of owner's equity, you can see indicated here that we have the net income for 2 months that we had from the income statement. And we carry this over to our statement of owner's equity. So we have to create the income statement first and then the statement of owner's equity, because the statement of owner's equity depends on that net income or net loss number from the income statement. Then from the statement of owner's equity, we take the ending capital number, so the Bright capital as of December 31st, 2018 in this case, and we're going to take that number and it's going to flow down into our balance sheet. So the balance sheet that you see here is the same type of balance sheet that we have seen in the first 3 chapters of the book, and this is the one we are going to be doing the deeper dive into. But this is that original one that we're used to seeing. And you'll notice here, you see our little blue line with the blue arrow there, and it indicates where that capital number went to on our balance sheet. And in order to create the balance sheet, we have to have that capital number, and in order to get that capital number, we have to create the statement of owner's equity. And to create the statement of owner's equity, we need the net income or net loss from the income statement. So that is the relationship between these 3 financial statements, and the reason why we have to prepare them in that specific order. So the classified balance sheet, we are going to be creating the classified balance sheet now moving forward. So anytime you were tasked with creating a balance sheet, I would expect that it would be a classified balance sheet here moving on. The classified balance sheet just does kind of a deeper dive, and it categorizes the accounts within the balance sheet and gives them more distinctive titles. So a lot of this is based on something that we call liquidity, and liquidity is how quickly can we convert that asset or that account into cash. And so we look at liquidity when we start to classify the different accounts within our balance sheet. And those different classifications go for the assets. At least we have the current assets, and current assets are assets that can be converted to cash, sold, or used within the next 12 months. So I typically like to say that they can be used within 1 year. Think about office supplies as an example here. Office supplies would be a current asset because I will probably use all of my pens up within 1 year. The next classification that we have here are long-term assets. So the long-term assets are also, they're still assets, they're still listed there. So we've got long-term assets. Within the long-term assets, we have 3 other classifications. We have long-term investments, property, plant, and equipment, and intangible assets. So long-term investments are investments or stocks that we hold within another company as a company ourselves, and we're going to hold on to those for longer than 1 year. Property, plant, and equipment, these are for those bigger assets that a building has, such as that a company has, such as a building or land or large pieces of manufacturing equipment, those types of things. And then we have intangible assets. And our intangible assets are long-term assets because typically we have them for a long time. And we call them intangible assets because these are things like patents that we hold. There's nothing that we can physically hold on to, but we know that we have those assets. And oftentimes we have intellectual property that are considered our intangible assets. So this could be like a secret recipe, or it could be a copyright or a patent that we hold on various different things. Then we move into the liabilities section of our classified balance sheet, and we also separate the liabilities into 2 different classifications. So we have current liabilities and we have long-term liabilities. The current liabilities, much like the current assets, can be paid off within 1 year. So we usually look at the current liabilities as we can pay them off within 1 year. Some examples would be accounts payable, salaries payable, and unearned revenue. Then we move into our long-term liabilities. These are longer-term liabilities that we cannot pay off within 1 year. These would be things like notes payable or a mortgage payable or bonds payable. So anytime we take out a loan, typically that loan is going to be a long-term liability. And the owner's equity in this case doesn't actually change. So the owner's equity will be just the same as it has been on the traditional balance sheet as well. So here we have an example of that classified balance sheet, and what you'll notice here on this example is you'll see that we have the different categories within the assets and the liabilities. So we always start with our current assets, and then we move into our long-term assets as well. In this case, this classified balance sheet only has property, plant, and equipment. It does not have long-term investments or intangible assets, but both of those could also go within that section. Then we move down into the liabilities, and we see that we have our current liabilities and we also have our long-term liabilities. Please note that for each of the sections and each of the subsections, there are totals there. So if we look at the current assets, we have all the current assets listed, and then it also gives us a total current assets. And the same thing happens with property, plant, and equipment, current liabilities, and long-term liabilities as well. And then of course, at the end, we have our capital under our owner's equity. So our next learning objective is utilizing our worksheet to prepare the financial statements. So we're going to utilize a worksheet to prepare the financial statements. This is a relatively simple process, especially if we have our worksheet already started, we have our adjusting entries done, and we have our adjusted trial balance in our worksheet done as well. We can easily determine what our income statement and balance sheet would look like on our worksheet, and we can also determine our net loss or net income on that same worksheet by looking at the different totals at the bottom of the worksheet. So here we have a completed worksheet. you'll notice that we have the unadjusted trial balance, the adjustments, the adjusted trial balance, and then we have the income statement and the balance sheet sections. So you'll notice on the income statement, again, those accounts are all towards the bottom, and we see those put into their proper places, and then we see the totals at the bottom. On this particular worksheet, we see that a net income is indicated. And we know this because we know that when our expenses are lower than our revenues, we know that we have a net income. If it were the opposite way, if our expenses were greater than our revenues, then we would have a net loss, and we would see that net loss indicated in this box right here, as opposed to where it is right now for the net income. And then we go over and we see our balance sheet, and please take note that on the balance sheet section, we also have our capital numbers that are there. Oh, I kind of messed that one up. Of course, our capital numbers would be there along with our liabilities and our assets. And again, if a net loss were indicated, we would see that number reported. We would see the 8550 reported right here, as opposed to where it is to indicate the net income. So our next learning objective here, see, we're getting right through this. We're going to look at closing entries for our next learning objective. So we're looking at the closing process and how this kind of affects our different financial statements, and why do we have the closing process. So the closing process will zero out all revenue and expense accounts. The reason why we do this is because we want to be able to determine our net income or net loss for very specific periods, and so therefore we're going to zero those out so it's not just a continuation of them. We call our revenue and expense accounts temporary accounts, along with our income summary account and our owner withdrawals accounts. We need to close all of our temporary accounts to permanent accounts. And the permanent accounts that we have indicated here are all of our asset accounts, our liability accounts, and our owner capital accounts. So note that all of our permanent accounts will show up on our balance sheet, and all of our temporary accounts show up on our income statement and our statement of owner's equity. All right, moving on with our closing process. So we are going to create what are called closing entries, and these closing entries transfer our revenues, expenses, and owner withdrawals to owner capital. In order to do so, we utilize an account called income summary. That income summary is a temporary account as well, and this just gives us a summary of our net income or net loss for the period before we close that out to our owner capital account. So you can see here by the graphic how these closing entries work and the order in which we do them. So the first closing entry that we do is that we close our revenue account to our income summary account. Then next we close our expense accounts to our income summary accounts. And then we close our income summary account to our capital account. And lastly, we close our withdrawals account to our capital account as well. This is a really great graphic, especially for those of you who are visual learners. So hopefully this will help you kind of understand the flow that is happening. So when we close these temporary accounts, the first account that we close out is we close out our revenue account. The whole point here is to make it zero. So our service revenue account typically has a credit balance. So we are going to debit it for whatever the total amount is in that account, and then we are going to credit income summary. The next step is to close out all of our expense accounts. Again, our goal here is to make them zero. They typically have a debit balance, and so we are going to credit those accounts and then debit income summary. And as you can see here, we utilized a compound closing entry. By compound closing entry, I simply mean that we are utilizing more than two accounts for our journal entry. In this case, we are utilizing several to close out all of our expense accounts at one time to our income summary account. So you can see here that we are debiting income summary for $8,950, and we are crediting our expense accounts for the totals that were in those accounts. If we were to add up all of the amounts in the expense accounts, it would equal that amount that we have debited the income summary account. After we close the revenue accounts and the expense accounts, we see here that we have an $8,550 credit balance in our income summary account, When we have a credit balance in our income summary account, this indicates that we have a net income. And that's really important moving forward, that we know that that means that we have a net income. So next we're going to close out our income summary account. And by closing out our income summary account, we are going to debit our income summary account and we are going to credit our capital account. By crediting our capital account, we are increasing the amount of capital that the owner has within the company by that $8,550, which was our net income amount. And if you remember from our statement of owner's equity, we add our net income to the existing capital to increase our capital. This is essentially doing the same thing, just in a slightly different way. The next thing that we need to do is we actually need to close out our withdrawals account. So we need to make that 0, which means that we need to subtract the amount of withdrawals from our capital. So the withdrawals account typically has a debit balance, so we are going to credit the owner withdrawals account, and then we are going to debit the capital account. By debiting the capital account, we are reducing that amount of capital because at some point the owner took money out of their business, probably to pay things like their rent or buy food, life's simple things. And we see that journal entry indicated here with a debit to the capital account and a credit to the withdrawals account. This is to close out the withdrawals account. This is to make that account 0 so that we can start fresh for our next period. Up until this point, all of the accounts that we have been dealing with have indicated a net income. However, if we have a net loss, what we will notice is that we will have a debit balance in our income summary account. And in that case, our journal entry would look as follows. It would be a debit to owner capital to reduce the amount of capital that the owner has, and it would be a credit to income summary to zero out that account. So once again, this journal entry is indicated if a net loss is happening for the indicated period. This is a great example of all of those closing entries, just kind of in one shot here. So we see that we start off by closing out our revenue account, then we close our expense accounts, then we close that temporary income summary accounts where we closed our revenues and expenses to, and then we close out our withdrawals account last. Again, this is just another great summary utilizing those T accounts to show those closings, and again showing you how we did those closings as indicated by those same colors that we saw in that first graphic. So we see green is first, followed then by the orange, followed by the blue, followed by the purple last. So our next learning objective here is to prepare the post-closing trial balance. When we prepare the post-closing trial balance, we do this at the end of the accounting cycle, and this post-closing trial balance will only have the balance sheet accounts listed on it. It only includes those permanent accounts, and we know that those permanent accounts are only those balance sheet accounts. So we can see here that our post-closing trial balance, and it only indicates our permanent accounts. So we have our asset accounts listed, followed by our liability accounts, followed by that capital account. You'll notice that this looks very, very similar to a balance sheet, and that is because it utilizes all of those balance sheet accounts. Our next objective here is describing the accounting cycle. So the accounting cycle is a process in which companies produce their financial statements for that specific period. So it all kind of ebbs and flows in the same order, and that would be the same for pretty much every business. That accounting cycle is going to look very much so the same because we follow the same steps, because accounting has been standardized over the course of many, many years. So this is an example of that accounting cycle. We see here with number 1, it's in the upper left-hand corner, where we start the beginning with the beginning account balances, then we analyze and journalize those transactions, we post the journal entries to the accounts, we compute the unadjusted trial balance, then we make our adjusting entries, then we move on from our adjusting entries to our adjusted trial balance, and from there we can create our 3 financial statements, the income statement, the statement of owner's equity, and the balance sheet. Then we perform our closing entries and then our post-closing trial balance. And note that this is a circular cycle, so we will repeat this every single accounting period and it will just flow right into the next. So learning objective 6 is our current ratio. So the current ratio compares the total current assets to the total current liabilities. And this gives us an idea of how able we are to pay off our current liabilities based on our current assets. So it's a very simple ratio. We simply take our total current assets and we divide it by our total current liabilities. So we can see here, as indicated by Kohl's, their total current assets and their total current liabilities, and it gives us 2 years. Usually when we look at the current ratios, we are going to look at a number of years so that we can compare those numbers. So we look and we see that the current ratio for 2015 is 1.95, and we see that the current ratio for 2016 is 1.87. So we see a decrease in the ratio from 2015 to 2016, and this indicates that Kohl's has deteriorated slightly in their ability to pay their debts. So what that means is that they will have a slightly harder time paying off their debts in 2016 than they would have had in 2015. So this last learning objective, this is on revising entries. I typically don't cover the appendix chapter or the appendix pages in our chapters, but I'm just going to go through this quickly. So if you don't want to listen, you don't have to, but this is just additional information. So reversing entries. So if we made a mistake, that would indicate that we have to make a reversing entry. We can do so. It will just look the opposite of our adjusting entries. These are not required by GAAP, so the generally accepted accounting principles, and they are used for convenience and to save time. So we will see that a lot of accountants will utilize them, but they are not required. The first adjusting entry that we're going to look at is accounting for accrued expenses. So in order to record accrued salaries of $1,200, Smart Touch Learning recorded the following adjusting entry. They debited salaries expense and they credited salaries payable. And then the adjusting entry would happen here. So after the adjusting entry, the following are noted. The income statement reports salaries expense of $4,800. The balance sheet reports salaries payable of $1,200. The $4,800 debit balance of salaries expense is closed on December 31st of 2018, and this is the closing entry. So we see income summary is debited for $4,800 and salary expense is credited for $4,800. After posting, we see that salaries expense has a zero balance. So assuming that Smart Touch Learning will pay its employees the second half of December's salaries along with the first half of January's on January 15th of 2019. On January 15th, the company would record the following, and this is without the reversing entry. So salaries payable would be debited $1,200, salaries expense would be debited $1,200, and cash would be credited for $2,400. And so then we see here that salaries payable has that zero balance. A reversing entry will switch the debit and credit of the previous entry, and again, these are simply done for ease and they are not required. So if we look at this, we see that the adjusting entry was made on December 31st, and it was a debit to salaries expense and a credit to salaries payable. The reversing entry would happen on the first day of the new period, and we would simply just reverse the entry. So we would debit salaries payable and credit salaries expense. So it's just a simple reverse of that. Then when we go to pay the employees on January 15th, this is what that journal entry would look like. So it just makes things look a little bit cleaner. So we would have a debit to salaries expense for $2,400 and a credit to cash for $2,400. Again, these are not necessary, but they can make your books look a little bit cleaner. And that's all I have for y'all. Let me know if you have any questions.